The company failed. How did this happen? 6.5 billion euros in debt. A pay TV gamble. A 300 million euro missed payment. A dynasty lost. They owned broadcasters. They owned film libraries. They owned sports rights. They owned influence. That empire collapsed into a single number. $6.5 billion. Families lost jobs. Banks lost patience. Clubs missed payouts. Markets changed. It started with a belief. Content is king. Control the content. Control the market. Kirch built on that belief. It bought rights. It bought studios. It bought distribution. It paid top prices for the Bundesliga and for major film catalogs. Those assets were hard to replicate. They were valuable. They were also illiquid. Early on, the math looked attractive. License fees came in. Broadcasters paid. Cash flowed. Executives celebrated. The company seemed untouchable. Lenders lined up. Politically backed banks opened doors. Loan syndicates signed. Limits rose. Then a decision changed the rules. Take those rights. Stop selling them. Keep them. Put them behind a subscription wall. Build a pay TV platform. Capture the subscriber. Control pricing. Replace volatile license deals with steady monthly fees. It was a bold plan. It was also expensive. Exclusive rights cost hundreds of millions up front. Building distribution and technology cost more. Marketing and subscriber subsidies burned cash. The balance sheet shifted. Liquid license receipts were exchanged for long payback periods. Short-term debt increased. Contingent guarantees multiplied. At first, it worked. Subscribers signed up. Headlines shouted growth. The platform blocked rivals. Clubs cheered. Cash flow improved in the first quarters. Investors applauded. The company gained leverage with content owners. Confidence soared, but confidence can hide cracks. Subscriber growth slowed. Churn rose. Content costs kept climbing. Competition tightened. New entrants undercut pricing. Technology costs rose faster than forecasts. The projected scale failed to arrive. Managers tried to hide the stress. Off-balance entities absorbed guarantees. Intercompany loans masked real exposures. Banks were reassured. Public filings lagged. Internally, accountants flagged mismatches. Middle managers warned. Their memos were buried. Short-term lenders still rolled paper. The company leaned on politically backed AAA banks. Those banks carried reputational incentives to support a national champion. They extended facilities. They structured convoluted deals. They accepted complex collateral and opaque guarantees. That acceptance mattered. It allowed the company to keep funding its losses, but it also amplified risk. The trigger was simple. A counterparty demanded payment. A guarantee was called. The company could not meet a $300 million obligation. The payment failed. The default was public. Lenders stopped rolling facilities. Confidence evaporated overnight. To the outside world, the $300 million sounded finite. To the system, it was a fuse. Off-balance guarantees and cross-entity exposure converted into consolidated liabilities. Lines of credit were withdrawn. Collateral was seized. Ratings dropped. The cost of capital spiked. A brief forensic moment explains the mechanics. Imagine two companies. One holds the rights, the other holds the debt. They promise to support each other. On paper, the debt sits with Company B. In practice, lenders treat the promise as if Company A has the liability. When the guarantee is called, Company A must pay. If it cannot, creditors accelerate. Hidden guarantees become real obligations. What started as contingent risk is enforced as actual debt. That conversion turns localized stress into system-wide failure. After the missed payment, a cascade began. Distribution partners paused new contracts. Suppliers froze deliveries. Employee hirings were halted. Bonus pools vanished. Suppliers demanded cash up front. Sports clubs that had received advance fees watched bank guarantees evaporate. The pay TV model lost momentum. Subscribers left. Churn accelerated. Major distribution partners pulled content or renegotiated terms. Competitors saw weakness and moved aggressively. The company could not cut costs fast enough. Rights amortization schedules remained fixed. Revenues shrank. Fixed costs did not. The next key turning point was a failed restructuring. Management reached for a deal. Creditors demanded transparency. Banks wanted collateral. New money required higher rates and tighter covenants. Equity could not provide quick capital. Negotiations failed. The window for a graceful recapitalization closed. Cross guarantees amplified the damage. A default in one legal entity triggered events of default across the group. Covenants tied to consolidated leverage ratios were breached. Term loans accelerated. Short-term facilities were recalled. Legal disputes proliferated. The group that once looked diversified behaved as a single economic unit. Now the mechanics of contagion are simple. Creditor A holds loans to Company 1. Creditor B holds to Company 2. Company 1 guarantees Company 2. Company 2 fails on a payment. Creditor B enforces the guarantee. Creditor A sees the economic exposure increase. Both creditors claim collateral. Asset sales begin. Buyers sense distress. Prices drop. Recoveries shrink. Losses multiply. Asset sales followed. Film libraries sold at discounts. Broadcast assets transferred under pressured deals. Sport rights were renegotiated or lost. Bundled packages, once negotiable for premium sums, now fetched fractions of their book value. Communities lost local programming. Clubs lost sponsorships. Employees were let go. Across the group, debt consolidated to $6.5 billion. Secured lenders recovered parts. Unsecured creditors were wiped out. Shareholders were diluted out, then wiped away. The dynasty dissolved. Look at a simplified balance sheet to see why. Before the crisis, high-value rights on the asset side. Large short-term bank debt on the liability side. Positive license income projected into future periods. After the crisis, rights remained on the assets but with sharply reduced market value. Short-term debt matured or was called. Off-balance guarantees were recognized. Equity went negative. Insolvency followed. Banks played a central role. Politically backed POPE banks had incentives beyond credit metrics. They supported the group because it was a national strategic player. That support delayed reckoning. But it also enabled larger bets. When the support stopped, the fall was faster. The same banks faced losses and reputational damage. Forensic economists trace the collapse to a few root causes: over-leverage, monopoly hubris, mispriced risk, opaque financing, and the moral hazard of politically linked lenders. Each factor raised systemic vulnerability. The human stories are stark. A mid-level manager in distribution recounts locked doors and unexplained memos. A stadium finance director remembers a promised fee that never arrived. A technician who built the pay TV backend recalls late paychecks. A banker who worked the files says he never saw so many contingent claims in one folder. Sports clubs missed payrolls for youth teams. Local advertisers lost slots that supported small businesses. Regional newsrooms were shuttered. The direct human toll included lost wages, broken careers, and community services cut. The collapse reshaped the market. Competitors and new entrants picked over the pieces. Tech platforms moved to secure streaming rights but at lower prices. Regulators tightened scrutiny of financing and reporting. Lenders demanded clearer collateral and fewer opaque guarantees. The prices for premium rights fell. Risk premia rose. A forensic insert shows the math behind the 300 million trigger. Covenant X required a minimum liquidity buffer. A guarantee call of $300 million reduced reported liquidity below the covenant. That breach allowed lenders to accelerate term debt. Acceleration required immediate repayment. Nobody could raise that cash in time. What seemed like a single payment became an obligation to multiple lenders. The arithmetic turned fatal. Pressure increased at every stage. Rights spending rose. Cash burn grew. Hidden financing multiplied. The $300 million default pushed the system past a tipping point. Credit lines froze. Defaults spread. The debt tally ballooned to $6.5 billion. Executives tried last-ditch moves. Emergency asset sales were proposed. Minority stake offers arrived. Some banks presented bridge financing with punitive rates. Shareholders resisted dilution. Employees hoped for rescue. Stakeholders argued in boardrooms. But timing mattered. Buyers demanded discounts the size of the risk. Creditors preferred to foreclose rather than trust future cash flows. When assets were sold, they sold cheap. Film libraries went to foreign buyers at discounts. Broadcast stations changed hands. Sport rights were parceled and sold to multiple buyers. The monopoly dissolved. Market concentration fell. Fragmentation rose. Legal battles followed. Creditors litigated guarantees. Plaintiffs alleged misrepresentation. Regulators investigated disclosures. Former executives testified about decisions in secrecy. Some executives faced scrutiny for failing to disclose contingent liabilities or for arranging opaque intercompany guarantees. The aftermath brought new rules. Lenders changed loan templates. Covenant packages required clearer liquidity tests. Off-balance entities attracted closer scrutiny. Regulators updated reporting standards for media rights and for related party transactions. Political pressure pushed for transparency on banks' dealings with national champions. The industry shifted. Valuations for exclusive rights now included higher risk premia. Buyers required stronger collateral. Clubs demanded more secure payment structures. The days of reckless bidding wars ended. Market discipline returned, harsher and more expensive. For people, the change was personal. A town lost its local channel. A sports academy closed. Long careers in legacy broadcast roles ended. New jobs appeared in streaming and tech. Different skills were rewarded. The culture changed. Forensic economists highlight one final mechanism. Cross-defaults and cascading covenants create a multiplier effect. A single covenant breach triggers acceleration. Acceleration triggers collateral calls. Collateral calls force sales. Sales lower market prices. Lower prices mean losses for lenders. Losses reduce available credit across markets. The initial shock ripples outward, beyond the original industry. The story leaves questions for modern empires. Which groups rely on opaque guarantees today? Which lenders are incentivized to hide risk for political reasons? Which sectors have illiquid assets and short liabilities? Those combinations are dangerous. In the end, $6.5 billion was not a spreadsheet error. It was a consequence. It was a price. The price of mistaking monopoly power for invulnerability. The price of financing growth with secrecy. The price of betting that loyalty and prestige would keep markets patient. The dynasty failed. The empire shattered. The market learned a costly lesson. Which modern empires are making the same bet?